Welcome to Global One Media's Stocks to Watch. I'm Michael Swido. I'm speaking today with John Fenig. He's the president of the Fenig Consulting Group and is someone who has his finger on the pulse of the financial markets. John, welcome to the show.
Thanks for having me, Michael.
John, you're in Arizona, I'm in Singapore, and together we're going to travel the world in this segment, starting with China, where equities and the Chinese renminbi are both coming under pressure. The CSI 300 index is trading at its lowest level in more than 4 years. The renminbi has depreciated to 7.31 versus the greenback. Capital, meanwhile, is reportedly exiting China at its fastest pace in years, as investors are concerned about the state of China's economy, as well as the health of its troubled property sector. So, John, tell us, what is your take on Chinese equities? Is it a good time to go bargain hunting?
You know, my background, Michael, is in mining and energy and commodities in general. So I look at that space more closely than, say, country funds or ETFs. But I would say that China was doing, there were a lot of experts, if you will, talking up China in the summertime. But now a lot of them have faded as we're seeing kind of a global contagion, in our view, kind of unfold here since October 7th. And the terrible attacks that happened in Israel. So, I think there is a case for a domino effect in international investing. And if you are investing in China right now or anywhere outside of, a safer jurisdiction, meaning, coming from someone who is in the US, I consider this pretty safe and I know it very well. So, if you have conviction in what you're doing, go for it. But I think when you look at a chart, Michael, of any market, whether it's China, the US, from 2009 to today, we've had a 14 and a half year bull run, right? I don't think anyone argues that we've had a lot of easy money made over the last nearly 15 years. And so I think you need to step back from that and say, okay, how much risk do I really want to take here? Because I always encourage my clients and followers to look at 15 to 20-year charts. Don't look at a 1 or 3-year chart of NVIDIA or something like that, right? Look at the entire long-term chart. For example, if you were looking at Amazon, back in, I don't know, the 0809 period, it was trading at $10 a share. And now it's trading at whatever, 130, right? So you've made multiples of your money. And is that long in the tooth? I would argue that we're not going to touch a momentum stock right now because there's just too much risk out there.
I love that you're taking a long-term perspective like that. I think it's really great information for investors to take on board. You also mentioned the term easy money, and it's worth noting that investors have been watching closely to see if Beijing introduces easy money, specifically new stimulus measures to boost China's economy. Just today, Beijing announced plans to issue more sovereign debt, which it's likely going to use to fund new construction projects. And its sovereign wealth fund has started buying ETFs, or exchange traded funds, in addition to banking shares, to give the country's stock markets a boost. If we bring it back to those stock markets, I'm wondering if there's particular sectors or stocks where you see good opportunity in China.
Yeah, so one of our holdings in our mining portfolio since inception in 2016 is Silvercorp, which is symbol SVM. We love Silvercorp. It's a Chinese mining company. They've been in China for a few decades and have a Chinese CEO and Dr. Feng. So I think that is a company to take a look at. I worked on the silver team at Sprott in 2016, 17. So that was one of the stocks that really caught my eye when we saw that pullback in the mining space. And it has a lot of leverage to the price of silver and it's producing at a very low cost. So that is something that we like. Another one is something I just mentioned not too long ago, because 60% of this commodity is produced in China. And that commodity is called tellurium. It's kind of obscure. It's the ninth most critical on the critical minerals list. But First Tellurium is a junior mining stock that is available, the only junior mining stock in the tellurium space. So we like things, Michael, that can, when you look under the hood at a stock like that, 60% of tellurium is produced in China. If China, for whatever reason, in 2024 decides not to produce, that tellurium and ship it to places like the U.S. or Canada, what does that mean for prices? Prices are going up, right? And solar panels are requiring tellurium for production. So like it's not an option. There's not something you can work around. You need it to make a solar panel. So then what happens to solar panel prices? When you look at their board of directors, there's four people from First Solar on their board on a little minor, junior stock that no one's ever heard of probably before. So we love opportunities like that that have, exponential growth potential because the market just seems to be overlooking it.
That's awesome. I don't hear a lot of people talking about Tellurium, so listeners take note. I want to turn to the Middle East now, where tensions are running high amid concerns that the war between Israel and Hamas is expanding to include other actors like Hezbollah or even Iran. This has many investors looking for safe havens. The Swiss franc, for example, is attracting a lot of attention recently. John, I'm wondering, what is your advice to investors in terms of how to manage this geopolitical risk? And is there a particular safe haven investment that you favor?
Yes. So we haven't been negative, Michael, on the US dollar. We've been believers that, contrary to 90% plus of my competition, that the US dollar can run alongside of something like gold. And you're seeing that happen right now, right? So we still think the US dollar is going to be relatively strong. However, that could change based on Fed policy or something out of the blue, like you just described, right? If Hezbollah and Iran get involved, this gets much wider real quick. And we've got two warships sitting right out there right now. Gerald Ford is one of our crown jewels, and this is escalating faster than I think people expected. So I would urge people to do your homework. Don't just look at your favorite website. Go look at international websites to understand what the perspective is about the war in different parts of the world, right? And then try to filter out the TikToks and the YouTubes and make sure that that's accurate information, not misinformation. Because, and I'd also encourage you to listen to President Biden, in his little speech, State of the Union last Thursday. He's mentioning things like Poland, Taiwan. I mean, I was pretty surprised that he's going that far and talking about that. That doesn't paint a wonderful picture. So I would honestly, take my foot off the accelerator if I was an investor here. And I'm not just suggesting that. We have pretty heavy cash positions in our portfolios right now. Just making sure that we don't get something wrong and get trapped on a weekend, So I'd say the safe haven of choice is gold. When you look at how gold has reacted since October 7th, it's been unbelievably good. If you look at October 13th action, for example, it was up 3.2% in one day, which was the single best day it's had since the pandemic in 2020. So there's big money looking at the mining sector. Sure doesn't feel like it on certain days, but I think that gold and silver are really, precious metals, not industrial metals that people can get behind in a world that we're moving towards, unfortunately. And you need to protect all the money that you've earned over the last, 14 and a half years in our view.
So I hear you saying pay attention to the news, but not just one site. Look broadly, look at international sites as well.
Yeah.
I hear you saying
Yeah.
gold and cash also. Keep your cash reserves.
Yes. And so cash is yielding in the US, 5.9%. Why wouldn't I keep something in there, right? When I can get 6% risk free? That's something that if we had this interview 18 months ago, I'd be getting 1%, right? Like, I mean, that's changed dramatically. So, I don't see a rush to get invested here in certain parts of the world. I just want to see charts, as a technician, I want to see charts and how they develop. A lot of the markets that we follow right now are right on the precipice of either breaking down or not, right? Look at the S&P, for example, in our market. If you cross 4,200 or 4,220, somewhere in there, wherever the 200-day moving average is right now, you're going to see further downside in that market because everyone's looking at that level, and it is holding right now, but we'll see as we progress through October.
All right, so talking about those charts, the Dow, the Nasdaq, the S&P 500, they are all down about 7% over the past 3 months. The Russell 2000 small cap index is doing even worse. It is down 15%. If we take a look at US equities, and I know you're not a near-term investor, so I'll ask you about the medium or long term. Are you a US bull or bear?
Oh, I am definitely a bear when it comes to those markets you just mentioned. We literally have no exposure to anything you just said. We are firm believers that the markets have made all-time highs. We've said that even May, June, July, as Nvidia and tech was breaking out. We just don't believe that you're going to make all-time highs here. That's sort of like rhetoric coming from Wall Street, and I spent 25 plus years on Wall Street. I know how it works. Portfolio managers, Michael, have to make bonuses, right? And those bonuses generally are going to be calculated based on your performance as of December 31st, right? And so there's this kind of last hurrah, I think, that you might see here in Q4 where we get portfolio managers to hold in there. Maybe the S&P does hold 4,200 and rally back up a bit, but you're not going to make all-time highs through that 4,800 plus level. That's just not going to happen in our view. There's too much risk in the world. So I think you're starting to see a breakdown in a lot of those indices you mentioned. One that we've always used to kind of look in the U.S. market, Michael, for risk is the Russell 2000. If you look at the Russell 2000 back in 0809, it broke down before everything else in the U.S. If you look at September of 2018, same thing, broke down before the S&P and the Dow and the Nasdaq. So as the Russell goes, so goes a lot of the U.S. market, and I would argue that it's not as liquid of an ETF or an index as people think because we're talking small caps, right? So there is a lot of risk out there right now. Again, I don't mean to be a dead horse, but it's like as an investor, there's really no rush right now. You have to kind of see how international events play out. You have to see how the Fed acts because we're kind of factoring in that the Fed is done, right? Like that's clearly what the markets are trading like. Like we're going to pause forever, and I don't know, or we're going to get cuts in Q1, right? Like I would love to see that as an investor in commodities. That would be very bullish for our sector. But I have to just say it like I see it. The November 1st meeting to me is completely off the table. There's a 1% probability of a hike. But December 13th is a 25% probability of a hike. And the January meeting, we've got a 33% probability of a hike. So there's still that probability out there that we see another hike and the Fed isn't done. And I think the markets would really dislike that.
No doubt, no doubt at all. Markets are definitely trying to price in that the rate hikes are done, and it's not clear, like you said, that they are. I want to turn now to a sector that you really focus on, and that's mining and commodities. You've been looking at that for years, and your company has created what it calls the Fennec Metals and Mining Portfolio, which historically
Right.
has performed better than gold ETFs. So good job on that. Tell us,
Thank you.
how is it performing this year?
So this year we're about 6% ahead of GDXJ, which is the junior mining, ETF of choice. It's got, about $4 billion in it, I think. GDX we're about 3% ahead of, which has got about 10 billion in it. And that is the mid to larger cap ETF in gold. We're way ahead of the silver ETFs because they've been really, really just trashed this year. I think there's a lot of opportunity in the silver space. One that I like that can kind of relate back to our conversation here is Aftermath Silver, which is AAGFF. Aftermath not only has a ton of silver potential, but it also has a lot of manganese, and manganese is a market that is largely controlled by China, right? Just like we talked about with tellurium, and they are trying to come out with their metallurgy results here probably within 2 to 3 weeks, and we'll see how much battery grade metal they have in the manganese category for the first time really in writing. So I'm watching that stock because if you see that does have that kind of potential, the market is not factoring that into prices whatsoever. So that's the kind of little stock that we like that has a lot of potential to upside if silver runs up. I'll also give you my kind of view on a couple of gold stocks because we just talked about gold as a commodity. I think gold is interesting here at the 1900 1900 an ounce level, but it's not as interesting as buying gold stocks because again, there's a lot of leverage to the price of gold in these names. One that we just started to follow is Goliath Resources, which is GOTRF. Has a large ownership from Crescat Capital and some other larger institutions. They just came out with really good news last week, the week of October 16th, and I was surprised that the market kind of shrugged it off. But that is sort of the market we're in right now, right? It takes a little bit of time for companies like Goliath to get traction, but I had a really nice volume uptick in September. on other news that they had, and it just seems like the market, may be missing the potential here. Um, Another one that I like is Cartier, which is in Canada as well, ECRFF, and Cartier's got 2.4 million ounces of gold. They bought a really large land package last year from O3. So O3 owns a lot of shares. Agnico AEM owns a lot of shares. So when you add up all of the ownership between those two institutions, companies, as well as larger investors, about 50% of the float is owned by people that are not selling at these prices. So I think that's another thing, Michael, that investors make a mistake about. They look at the capital structure of a stock and they see 320 million shares out, and obviously the first reaction is that's a lot of shares. But when you like do the homework to see what I just said, you see that this company might only have 160 million shares in the public float. So it has the ability to move more when gold really breaks to new highs next year than people expect.
So your Fennec Metals and Mining portfolio, if I understand correctly, I can't just buy into it, but I can subscribe to a service where you tell me what's in it and where you tell me what's changing. Is that right?
That's right. Yeah, we've been approached by some ETF companies and mutual fund companies, but I really like being on my own at this point in my career. At least as I sit here today, we don't want to put it into a public vehicle just yet. I've been overseeing it for almost 8 years now, so our 3, 5, and 7 year numbers as of September 30th are top decile in the sector, and we're very proud of that. But yeah, we are very communicative, Michael, with our clients. We put out something immediately after Israel, 2 paragraphs talking about how that's going to affect the broad market. How is that going to affect gold? How would that affect defense stocks? I mean, this is the kind of stuff I think that there's a particular type of client that wants real time information in their inbox, not just about stocks, but also about the macro and how the macro affects those stocks, right? So we look at non-farm payrolls in the U.S. We look at GDP. We look at the Fed, obviously, and we're commenting on all of these things regularly.
Awesome. Listen, I want to play a game with you right now. It's called Bull or Bear. I'm going to name a name.
Okay.
Sorry, I'm going to name an asset or commodity, and you briefly give us your take on it. Are you game to play?
Sure.
All right. So I'll name it. You tell us whether you're a bull or a bear, and you quickly tell us why. Number one, platinum.
Bull. It seems to be heavily shorted right now, mostly by European entities. The ticker to use in the ETF world is PPLT.
You mentioned it's shorted. The price of platinum is currently down about 18% this year. Next up, gold.
Bull. Gold has held that 1800 level really well. That's been heavily watched. And I think, Michael, since we saw the financial crisis in March in the US, as well as the recent activity in Israel in October, you're starting to put an additional floor on gold prices. So we see all time highs next year.
Nickel.
Bull. Not necessarily for the price of nickel, but for nickel stocks. And by that, I mean, you're seeing Elon Musk and a bunch of larger institutions get really interested in nickel, right? Why? Because a battery of a Tesla is a large part of that is nickel. So he is locking up deals with some of the junior stocks that I follow and own, where he may just buy 9.9% of the company, right? But he's tying up future production. Glencore is doing the same thing. I saw they just did 2 deals with juniors in the last few months, and they're a commodities giant. So when you see larger entities doing this, I think it's very bullish.
All right. Last one here is clean energy ETFs, like those that invest in lithium and EV batteries.
That one is sort of bull and bear. It really depends on the ETF, right? If you look at lithium, the one that I track is LIT. LIT as an ETF has been in a downward spiral here for weeks. So it's a hot sector of the commodity world for sure. But I think a lot of the shine came off this year as investors started to look under the hood a little bit more and understand, what exactly is this lithium stock doing? What is the potential for this over 3 to 5 years, not just in the near term? And we still like certain lithium stocks, Michael, but we're not, just buying hand over fist, being very selective.
So a lot of our viewers tend to skew towards investors in their 20s or 30s. Before we wrap up, what advice do you have for them? One tip.
one tip is don't buy everything all at once. We buy positions 6 to 10 times, and my first entry point is never large, unless there's just spectacular news, right? But it's really a mistake because looking at the mining space, a lot of people bought into that FOMO move in 2020 following the pandemic, and they're sitting on huge losses right now. So my theory is buy small at first, and then as you get more conviction and understand the thesis of the company, buy more.
Fantastic advice. I love it. Don't buy all at once. And I'll tell you, I'm going to go back and watch this interview again because you have had a bunch of great tips in here, and I'm going to have to go back and check those stock tickers. So I've been speaking with Fennec Consulting Group President John Fennec. John, thank you very much. And you've been watching Global One Media's Stocks to Watch. I'm Michael Suedo.